Okay, so we spoke yesterday about the balance sheet, what it is, what it means from a very basic perspective, and more fundamentally the formula that should always hold assets minus liabilities equals shareholders' equity, and the struggle with projecting a balance sheet. So we laid in the historical balance sheet. The struggle with projecting the balance sheet is to make sure that we are modeling out each line item going forward and doing it in such a way that this formula still holds. So it's important to note, it's important to note that there are two ways a model is structured, right? One where the cash flow statement drives the balance sheet, and another where the balance sheet drives the cash flow statement. So you will see, as an analyst, both versions of it. The latter is more often in private equity. And the reason why you might see models where balance sheet drives the cash flow statement, because they're dealing with companies that maybe haven't been audited, don't require GAAP financials, don't require a cash flow statement. Right? If you're a private business, you're not required to submit a cash flow statement. You're required to report a statement of earnings for tax purposes and a statement of balances for tax purposes. You're not required to produce a cash flow statement unless you're required to have an audited set of financials. But a lot of times you might look at private businesses where you have an income statement and a balance sheet and you have nothing else to go by. So you will find yourself having to back solve into a cash flow statement by using the income statement and the balance sheet. So a lot of times in private equity you might see those models, and we'll look at one later. So that's one way to model, right? You lay out the historical income statement, you lay out the historical balance sheet, and you don't have a cash flow statement, and you have to create it from scratch. And this is why I'm starting to, when I give you the understanding of income statement and cash flow statement, hopefully it's not just about memorizing these things, it's about conceptualizing where the cash flow statement comes from, understanding that it comes from, at least from the cash flow from operations, portions of the income statement. You're building working capital, not from memorizing line items, but understanding how to create it from scratch, because you might be faced with these situations where you're going to have to build your own cash flow statement from scratch, and we'll see that. The other way is the cash flow statement drives the balance sheet, and that's done more often in kind of bulge bracket banking in larger businesses. So although both are done and are techniques of modeling, we prefer the cash flow drives the balance sheet method for two good reasons. One, I think it's logically more, you first created a statement of income for tax purposes, for government purposes, and then you taking that net income and backing into, as we've discussed, how much of that net income is cash, and then you're using the cash flow statement to drive the balance sheet. Of all the three statements, the cash flow statement is the one that is generally the most accurate. So you really don't want to plug that one. It's generally the most accurate because it's one that is often tied to the actual bank statements. Right? It's not based on non-cash items that may or may not be subjective. Right? A lot of these things, revenue recognition, depreciation, is subjective. Cash is tangible. The other reason why I think the balance sheet, the cash statement driving the balance sheet method is more accurate is I'm going to take an example of PP&E. So we didn't talk about how PP&E is projected, but you should hopefully start to understand that PP&E is driven forward in the next year by two things. What do you guys think? I mean, you guys have all probably taken a look at it already. What drives next year's PP&E? CapEx and depreciation. You have property this year. Next year's property is increased by the capital expenditures. The capital expenditures is the improvement or additions to property, and property is decreased by depreciation. So if you had a balance sheet that showed 2014 PP&E of 1,000, right? And let's say you had 2015, let's say this is historical, right? 2015 of 1,500 PP&E, right? The question is, let's say you were faced with, you had a model that had the income statement, the balance sheet, and you're trying to figure out what the cash flow statement is, right? So you're deciding to back into the cash flow statement instead of doing it the other way. What does this mean for CapEx or depreciation? If you know you had an increase of PP&E from 1,000 to 1,500, What could that mean?
It's not clear.
It's not clear. Right? That's what I'm getting to. Yeah, but it could mean CapEx is 500. Right? CapEx increases that. Right? Or it could mean that CapEx was 750, but D&A was 250. Right? CapEx has gone up by 750, but then depreciation brought it down by 250. Or it could mean that CapEx was 1,000, D&A is 250, and maybe there's an asset write-down, which we'll talk about, of an additional 250. You don't know what could happen, right? There could be a multitude of variations that could have brought your PPD from 2004 to 2015. These are cash flow statement line items, so if you had the cash flow statement, you can use the cash flow statement to build to balance sheet items with a lot more accuracy. This would give you an idea as to all the movements in between. So this is a simple example because in reality you can look up the CapEx and D&A and things like that. But this is just a broad example, hopefully illustrating why starting with the cash flow statement and building to the balance sheet gives you a more accurate model, as opposed to going the other way around. So that's why we use cash flow drives the balance sheet. But it's important to know that both exist because you'll probably be forced, because of the type of situation, to have to back into a cash flow statement in order to do that. Any questions on that? Okay, so given that, the way we project the balance sheet is we use the cash flow statement to project the balance sheet, just like we do all these flows, income statement, cash flow statement, balance sheet. And so the practice and the theory is each and every cash flow statement line item must drive an asset, a liability, or a shareholder's equity. Each asset, liability, or shareholder's equity should be driven by some cash change. And you should start to get that because of the way we do all this stuff on the board. So what we do is we look at each and every cash flow statement line item and we ask ourselves two questions. One, which balance sheet line item does this affect? And two, in what way? And so when we make sure that we've used each and every cash flow statement line item in the balance sheet in the proper way, our balance sheet must be in balance. So I think it's easier, instead of looking at it on the slides, to look at it in practice. For example, on the top we have cash, right? Cash was 6550. What drives cash? What impacts cash on the cash flow statement? Which line item? Cash. Change in cash and cash equivalents. And so if we look at the cash flow statement and to say in 2013 we had generated 2528.5 in change in cash equivalents, what does that mean for our cash? Does that increase our cash balance or does that decrease our cash balance? Increases, right? Just like we do on the board, right? If we've generated 2.5 billion in cash in 2013, that means our cash balance has increased from 6550 by $2.5 billion. So in 2013, the formula we're going to use is equals, we're going to start with the year before, and we're going to add that to the cash generated in 2013. So we're going to have year before plus cash flow statement 2528.5. Our cash has gone up from 6.5 by 2.5 to $9 billion. And what I'm going to do is I'm going to highlight in a different color, I guess I'll use green, this line item to make sure that I've used that line item, because the way that a balance sheet stays in balance is when we are sure that we've utilized each and every cash flow statement line item in the balance sheet once and only one time. So this is going to help you understand why balance sheets go out of balance. Okay, how about receivables? So in other words, which cash flow statement line item impacts receivables? Change in AR working capital. Did it on the board, right? If the change in working capital on the cash flow statement is 146.5, should that increase or decrease our balance? decrease, right? Cash comes in, we've collected. Cash comes in, it reduces. So the receivables is going to be the year before's balance minus the cash. Cash is coming in, we're going to reduce this by the cash coming in. So the year before minus the cash flow statement changes in accounts receivable. And we should see this go down. And I'm going to go ahead and highlight in green the 146.5.
So why are we minusing it?
Because it'll reduce by 146.5 because we've collected. Next, inventory. So what cash flow statement line item drives the inventory? Change in inventory. Change in inventory is negative 148.4. What does that mean? We've purchased, we've bought inventory. Inventory goes up. Inventory goes up. So the formula is going to be inventory from the year before minus change in inventory. It'll effectively be double negative. Minus the negative 148 effectively means plus 148 is going to bring inventory up. Notice the pattern, right? It's always starting with the 2012 balance plus or minus the cash flow change. And notice for every asset, it's a minus. It's a minus because of the relationship between the asset and cash is the opposite, right? If cash is going up, the asset's going down. You sold. If cash is going down, the asset's going up. The only exception to that is the cash balance, because if cash is going up, then cash is going up. So if the relationship is direct, where if cash going up means the balance is going up, it's a plus. If it's an opposite relationship, it's a minus. So a couple of things and important to realize in the technique of building a balance sheet is if you balance it, if you use consistent formula like this, it's more error-proof, it's easier to solve, it's easier to resolve. So we're going to go through a technique where if you're learning the method this way, it should never take you more than 30 minutes to solve an unbalanced balance sheet. Guaranteed. Guaranteed. I remember this, and this is a good example where there was a guy, and this is before we had the school. Right before we had the school, we were just kind of going to the firms and doing like group in-house trainings. And one guy called to ask about the materials, and he wanted to do like a case study on his model. So he sent me the model. He was an associate. And I looked at his model, and he had like a 0.01 imbalance. I said, well, let's fix it. And he goes, this model's been passed around from the clients for about 4 or 5 years. It's a rounding error. It's never a rounding error. I said, let's go through. We have a technique. We'll teach you the technique. Let's go through it. On the phone, he goes, I'm an associate. I was at whatever bank. You know, he was kind of a little arrogant. He said, the other guy before couldn't balance it, couldn't balance it. So let's do the method together. So we did the method together, and literally in 15 minutes we found out what the problem was. So, and the reason why is just people aren't taught with the core underlying concepts. They're just used to just plugging around and trying to figure it out, and not to any fault behind. A lot of times when the model goes through this evolutionary process where this is projected one way and this is projected another way, and it starts to turn into this mess, right? But despite that, you can still print out the cash flow statement on paper, you can print out the balance sheet on paper, and you can take a pencil and a calculator and go through this method and still find, no matter, even if the model's a complete mess, still find what's wrong with the balance sheet if you understand the basic idea that each balance sheet line item is driven by one cash flow statement line item, and that if the cash statement line item is not driving the balance sheet, there's an imbalance. That's how the model stays in balance. And a lot of people are just, especially as analysts, you get so caught in the technicals, just don't step back and think about it that way. So the organization and the way you build the model is key, and more importantly, your conceptual understanding of why it's organized the way it is. So that's the way I want to kind of go through that. And most importantly for you guys, if you're doing model exams and you can balance these things quickly, that will be very impressive. So that's why part 3 of the exam will be to balance a balance sheet. And we'll do one together after the break. We'll do some practice of those. Inventories. I thought we did inventories. Prepaid expenses. How do we do prepaid expenses? two questions, right? Same two questions. What cash flow statement line item drives inventory? Change in inventory. Change in inventory. Sorry, change in prepaid expenses. Did you say change in inventory? Because I confused you, because I said inventory. Okay, but change in prepaid expenses is negative. So that would drive the prepaid expense balance up or down? Up. It's an asset. Opposite. So the formula is going to be the year before minus change in prepaid expenses. So again, look for the consistency in the formula. Here it is. For all assets, we use minus. Basic formula is it's the balance sheet from the year before plus or minus the cash flow change. That should be the same core formula for every asset, liability, shareholders' equity. It will never have to be anything different. For all assets, it's minus except cash. Make sure you kind of have that. Always. Other current assets. So when you get to other stuff, it gets kind of confusing. What line item would impact other current assets? Discontinued operations. I don't think we have anything. Oh, we do. Loss from discontinued operations. We can plug that in. It's 0. It's not going to make a difference. But just to make sure that we've linked everything, let's link in the loss from discontinued operations into this discontinued operations. So stick to the same formula. Year before minus this discontinued operations. So a lot of people, when they first see this, they get confused. They think there's no line item anymore for discontinued operations, which means this is 0. This is not 0. If there's no line item in the cash flow statement that impacts it, it just means it's not changing. It doesn't mean it goes to 0. If this were to go from 89 to 0, that means the cash flow statement is plus 89. So don't bring this to 0 just because there's no cash flow statement line item to drive it. If there's no cash flow statement line item to impact it, that means it's not changing, right? So don't get confused by that. Okay, we can now total our current assets and continue to the long-term assets. So what cash flow statement line items drive our PP&E? CapEx and depreciation. Minus, minus. Always a minus for the assets. So this is going to be equal to the year before minus CapEx. Minus CapEx, which will bring it up, right? Minus the minus. So minus CapEx will bring this up by CapEx. Minus depreciation. Minus depreciation will bring it down by depreciation. So always a minus. Guys got that so far? Next, goodwill. What cash flow statement line item impacts goodwill? And there's really no, and we'll talk about goodwill more in M&A, there's really no line item named goodwill. So again, if there's nothing in the cash flow statement that drives the balance sheet line item, it doesn't go to 0, it just remains unchanged. So for now, I'm going to keep this flat.
You just go to your cash. So.
Cash flow?
You didn't know
Cash?
So you just go to 39.
Yep. 25285. You got a different number?
Yeah. What's your depreciation number?
85917.
Okay.
You got that?
Yeah.
What is your cash from financing activities? Total.
12, 8, 8, 9, 4, 9. Yeah.
And then the investing?
16,
14.
14,651, yeah,
And your net income?
29.
What's your net income?
No, that's,
Yours too?
income's right.
Minus 2,475.
And Brendan, what's your?
Yeah, it must just be a total of,
Because your net income matches?
yeah, everything matches, just like total operating.
Total operating? Oh, that's my mistake.
It's yours.
Oh, because I fixed it here and then I didn't fix it there. Sorry. Is that what you're saying, James?
So now do you have here?
That was my problem. When we added this accrued taxes row, I overlooked this total. Okay? James? Other assets. So for now, as we get more complex with these balance sheet line items, we'll dig into more complicated situations. But I'm going to leave the other assets flat. And I'm going to go back at the end because what I'm doing is I'm highlighting as I go along. And I'm linking in all the major line items because you're probably seeing the cash statement. A lot of these little line items, you don't know where they go. Until you know better, because it's tough, it's impossible to know at this stage as an analyst, intern, whatever. Usually I just lump them all into some other category. They're small, they're meaningless. I just want to focus on the major line items now. I'll show you what I mean. So for now, I'm gonna go down, I'm gonna link in all the major line items, highlighting, it's important that I highlight the items in the cash statement as they go along. At the end, I'm going to see what's left over, and I'll go back and say, all right, well, where can I lump these extra line items? Should they go into other assets, other liabilities? You're always going to be faced with that. So I'll show you that technique. Yeah, Robert. It went up because I had a mistake in my model. My mistake in my model was the cash from operating activities was not totaling correctly. It was not including the 386.6 because I had added that rough. Yes, David.
I think last class we mentioned that the auditors, because of auditing and so on, adjustments that it might not balance. I just want to understand why.
No, this will always balance. The balance sheet?
Yeah, for fire year?
Always should balance.
Okay.
Yeah. Now, what I had said last time is if you try to, historically, here's a good example. If you look at the AR, it's 5089, and it's gone up to 5937, which means historically my cash flow statement should show a negative 848. But my cash flow statement says negative 796. That'll never match. That'll never match. Why is that not matching? There's write-ups, there's write-downs. Don't ever worry about it. You'll never get that tied. That's what.
Audit, like if you look at income, cash flow, and then balance, the audited version should still flow correctly from that direction. But it's just when you compare, when you go backwards, when you go to balance sheets, when you go back to the cash flow, that's when we find discrepancy.
I think it's the auditing process that's causing these discrepancies because you'll have a cash flow statement of 796, and then auditors come in, and maybe this was. Should this have been? Maybe this was at one point. Maybe they did build up 796 in cash flow, but then the auditors came in and said, well, I'm going to make an adjustment to your receivables. I'm going to write up the value from 5885 to 5937, and it no longer matches what actually happened in your cash flow statement. I think that's what's happening in reality in operations. But I don't know if that's your question, but I think that's what's happening. Was that your question?
I guess I was looking for like certain ways that they manipulate the numbers, so I
Yeah.
know which direction to go in. like whether you go from two balance sheets and you go backwards and back solve for cash, or whether you go from cash flow forward to balance sheet for 1 year.
For what purpose?
If there's a discrepancy there, I guess it'd be useful to know what direction.
If there's a discrepancy, it's usually a discrepancy in the balance sheet line items. They're probably writing up or writing down assets. That's probably where it is, although you never know for sure. The cash flow statement is usually the one that the auditors have tied to actual monies changing hands. So that should be the most accurate, if that answers your question. But you're talking Ernst & Young stuff, not banking stuff, really. Okay, let's take a break now before we get to liabilities. I think it's a good time. I'm gonna save this. So for the liabilities, which cash flow statement line item drives short-term borrowings on the cash flow statement? Short-term borrowings. Even though it's not linked in yet, which direction should it drive the short-term debt? If it's positive, would short-term debt increase or decrease? Increase. Right. Borrow money, cash goes in, you get an obligation. So I'm going to highlight this green to indicate that I've used that line item, and the short-term net borrowing is going to be equal to the year before plus cash flow statement short-term borrowings. Yeah, just pass it behind you.
Just to recap.
Yeah.
So the three numbers there, other current assets, goodwill, and other assets and deferred charges, you just equal to sell that. Or did you link something in just like I just did?
No, they just equal the sellback.
Yeah.
Yep, zero change.
I have a question about that.
Yeah.
On the cash flow statement of the investment section, there's investment in business acquisitions.
Mm-hmm.
That should be linked to goodwill, I mean, eventually, or?
Maybe, maybe not. We'll get there. We'll get there. We'll get there. Okay. Accounts payable. What cash flow statement line item drives accounts payable? Say again? Changes in accounts payable. And changes in accounts payable is positive. So will that increase or decrease the accounts payable account? Increase. Liability. Cash up, liability up. Accounts payable is a liability. For every liability, cash up, liability up. So this is going to be equal to the year before plus changes in accounts payable on the cash flow statement. Right? Accrued liabilities. Which cash flow statement line item affects it? Changes in accrued liabilities. It's 1.3 billion. Does that drive it up or down? Up. Okay. Again, liability, cash up, liability up. This is going to be the year before plus the liability. So again, you can see the pattern for liabilities. It's always for every balance sheet line item, it should be the year before plus or minus the change. For every liability, it's plus. For every asset, it's minus. For every liability, it's plus. Very simple. Okay, accrued income taxes. Changes in accrued income taxes. So accrued income taxes is a minus. Should that increase or reduce our balance? Reduce. So year before plus cash flow statement, changes in accrued taxes. How about long-term debt due within a year?
Current portion of long-term liability.
Current portion of long-term liabilities, which doesn't exist. So for some reason they don't have a line item for it. So if they don't have a line item for it, we'll keep it flat. Long-term debt due within a year, we'll stay flat. Year before plus, there's no line, there's no current portion of, if there was, there is no current portion of long-term liabilities to affect that. How about capital leases due within 1 year? Everything from the cash flow. Nothing from other statements. They don't distinguish. Keep it flat. If you had linked it from the debt schedule and it wasn't in the cash flow, you'd have a balance sheet problem. So everything from the cash flow. Current liabilities of discontinued operations. I don't see anything else related to discontinued operations here. We had one, we chose to, it's zero anyway, but we chose to link it into the assets for discontinued operations. So let's leave it flat for now. Those are our current liabilities, so make sure you have that. Excuse me. Bless you. Okay, long-term debt. What drives long-term debt? Financing activities, long-term debt, which is currently empty, but we will still link it through by taking the year before long-term debt plus long-term borrowings, row 30. And the capital leases. How about the capital leases? Same idea. Capital leases, there's capital lease obligations, row 35. So this is going to be equal to the year before plus 35 capital lease obligations. Everyone okay up to here? Any questions on this stuff? Question on any line items? Okay, deferred taxes. Where does that come from? Deferred taxes. Do they have deferred taxes? Oh yeah, we pulled it in ourselves. Year before plus deferred taxes up in the operating activities. Deferred income taxes. Well, nothing. It's deferred taxes, majority of it. What their end other is, we can look it up. But non-controlling interest or redeemable non-controlling interest. I don't think you'll see this too often. Redeemable non-controlling interest is a portion of the non-controlling interest that the company is allowed to buy back at any portion of time. So it's listed as a liability. It's a special. I had to research that. You don't see that too often. I don't remember if there's anything related to redeemable non-controlling interest. Here, purchase of redeemable non-controlling interest. Okay, so there you go. So we'll link it in there. We'll link it in. It's zero anyway. It doesn't exist anymore. But we'll still link it in. So the year before plus the purchase of redeemable non-controlling interest. And that completes our total liabilities. So make sure you have those numbers and all the liabilities matching. You guys okay?
Yep.
Okay. Shareholders' equity, common stock. What do we do with common stock? Is there any line item in the cash flow statement related to common stock? First of all, common stock would be in which section of the cash flow statement? Financing. So there's this purchase of common stock, which is treasury stock. Most companies have a separate line item for treasury stock. If you were to buy back stock, it would never go in the common stock par value plus additional paid in capital line item. So that's separate. So you wouldn't put that in here. There's nothing else, I don't know why, but Walmart has nothing else related to the issuance of common stock in the line item. So we're going to keep this flat for now. Year before plus no change. That was unusual that they didn't have that. I guess they just haven't been doing any stock raises. We're going to model one in though. And when we do, we're going to add our own line. Okay, what about retained earnings? Retained earnings, what impacts retained earnings?
Dividend.
Say again?
Dividend payout.
Dividend payout, net income, right? Retained earnings is the earnings after any payouts to equity holders. So it's the net income after dividends. So it's the year before plus cash flow statement, net income plus dividends paid. Right? Plus net income plus dividends. Always plus. With shareholders' equity, I forgot to mention, shareholders' equity is just like liabilities, always a plus. If you were to raise stock, you'd get money, stock goes up. If you were to buy back stock, you spend money, stock goes down. True for every shareholder, for all shareholders' equity line items. That should be 82349. Which handles dividends paid and net income. Okay, now we have accumulated other comprehensive income. What is that? You guys know what that is?
All the items.
Matt. Sorry. All right, he has it. Go for it. Or he said it.
It's basically, because accounts don't want to be very volatile, then
Yeah, so say again, so what?
It's like derivatives and
Derivatives,
foreign currency.
foreign currency, some write-ups, write-downs. There are, it's an addition to the income statement. You will see a statement of other comprehensive income now reported in 10Ks. These are items that companies had been reporting as other income, which GAAP has ruled as inadmissible to be listed under other income. So things like adjustments based on derivative hedges, foreign currency adjustments. So when you have companies operating in other foreign subsidiaries and there's currency fluctuations, all the adjustments based on these fluctuations cannot be reported under net income. So companies report this stuff under a secondary statement called statement of other comprehensive income. So this is a changing and ever improving rule. So if you want to get an idea as to what those line items are for your company, you can look at the statement of other comprehensive income and get an idea as to what line items statements of other comprehensive make up. Currency translation, net change in fair value of derivatives. So basically, you really don't need to care about that. But this statement is not, you don't model out, you don't report, you don't really. What this does help you do is identify which line items in the cash flow statement might link into the statement of other comprehensive income rather than retained earnings. So if you see anything related to currency translation, right, that would link into other comprehensive income. Anything related to adjustment based on values of derivatives, that would link into other comprehensive income. So this gives you a clue into what may link into the statement of other comprehensive income. And so it's kind of a vague thing, and it's kind of tough for you guys to really understand where that links in. But this goes back into what I mentioned in the beginning. When modeling out the balance sheet, what I would recommend is you're always going to find all these little side kind of line items that aren't major line items. They're usually quite nominal, and you're not going to know where to link them into in the balance sheet. Even associates probably don't even know because they're line items that are new or unique to the business. So my recommendation is, and this is why I'm highlighting, go through all the line items, add the major line items that you know link into the balance sheet. For example, depreciation always goes into PP&E. Cash always goes into cash. AR always goes into AR. And then see what you have left and try to guesstimate where these leftover line items should go. So that's what we're doing now. So for example, what do we not include? Other operating activities. We did not link in. What else? These that George was talking about, the proceeds from disposal of PP&E, investments, all these other line items, where should they go? So when you're done linking the major line items in from your cash flow statement to the balance sheet, you're going to see all these leftover line items, and you're going to have to guesstimate where should these go. And there's basically three major categories they could possibly go into. They can go into other assets, other liabilities, or other comprehensive income. And in all honesty, it really doesn't matter where it goes because these aren't line items that are going to be a major impact to your valuation. But if you don't include them, your model's not going to balance. So the most important thing is that you include them somewhere. And it all nets out. So if you put something into other assets when it should have been in other liabilities, no matter where you go, it's going to net out to the same shareholder's equity value. So it's not too much of a major, but there are techniques to kind of deduce where they could possibly go, and that's something that I don't expect you to know right away. What you should know now is at least to identify where these lines are and just to know to link them in somewhere in the balance sheet so you have a balance sheet. That's the most important thing. And so if there's anything related to foreign currency, derivatives, write-ups, write-downs, then you'll know that at least they should go into other comprehensive income. That rule you can memorize. So for example, I see, what do I have left over? I have other investments. What else do I have left over? I have this other financing activity. I have this effective exchange rates on cash, foreign currency. This will go into other comprehensive income, foreign currency. So my point is, now that we've done the major lines of the balance sheet, our balance sheet's not going to balance, right? We're not done yet. What goes into some of these major line items. So we have other operating activities, or other operating activities we didn't link in. Where could this go? Could this go into our other assets, our other, well, we don't have other liabilities. So should it go into other assets? That makes it easier. Should it go into other assets, or should it go into other comprehensive income? What do you think? Probably other assets. If it was related to foreign currency, if it was related to financings, if it was related to derivative hedges, these are things that go into other comprehensive income. Just start to get familiar with that. It takes time to understand. So I would take this leftover other operating activity line item and link it into other assets. So if you recall, these other assets, we just kind of left it 0, just equal to the year before, would be equal to the year before minus cash flow statement, other operating activities. Yes, David.
If we were looking at this balance sheet from an investor's perspective,
Yeah.
and you were looking for things that were making attractive investment, like I recognize that it's going to vary across the industry, but for Walmart specifically, what would you look for on the balance sheet?
Let's finish this first, and then we'll. Yeah, how do you analyze all this and interpret it? It's actually a really important question. I can't answer it now because our debts, which is going to be one of the most major things an investor is going to look for, are not linked in yet. So if you don't mind reminding me when we're done and we're vetting the analysis, but that's a really important question. So it's a good way it's good that you're thinking about it that way. But let's. There's a few things that you would absolutely look at. I don't want to feel like I'm dismissing your question. I think it's a really important question, but let's just have this balanced and going first before we ask it. And the same thing goes for what do you look for in a cash flow statement and we look for the income statement. So I'm glad you asked the question, but let's get it done and then let's think about the interpretive side of it. But good point. Okay, so we got that. What else did we not link in? So we linked in basically every operating activity. What we didn't link in, to George's point, disposing PP&E. Where does disposing PP&E go? Even though it's 0, where would it go? PP&E. It should, right? You dispose the property, the value of the property goes down. That should go into PP&E. Investments in businesses. It could be a little bit goodwill. We didn't talk about M&A yet, but when you're investing in businesses, there's two parts to it. There's the part of the business that's the asset. That would go into PP&E. There's a part of the business that's intangible. That would go into goodwill. So we don't know which portion that's going to go into, and you never do as an analyst, so I would just pick one. Usually you just throw it into PP&E. It's 0 here. It doesn't matter. I'm going to put this into PP&E, but in reality, and we'll learn this when we do M&A, it's going to be a combination of your assets. There's every business that you acquire has fixed assets, tangible and intangible. The intangible portion will go into PP&E. The tangible portion goes to PP&E. The intangible goes into goodwill. But as an analyst, you'll never be able to break that out. So you just pick one. Again, this is where it doesn't really matter because from an investor's standpoint, I'll answer David's question a little bit. You're only concerned about the total asset value because you're going to borrow money against it. You're going to look at, we'll look at that later. But so don't get too hung up, especially at this level, about which the intricacies of should it go into this one or should it go into, as long as it's linking in and as long as you got the major line items, that's all you care about. And as long as your balance sheet is balancing, that's the most important thing. So these two line items, well, let's link into PP&E. So we're going to append our PP&E formula to, we're going to tack onto this minus cash flow statement, disposing property, minus investing in businesses, minus. And then we have this other investing activities. Where do you think this would go? What could it be? Probably other assets. Other investing activities is investing in securities. If you invest in securities, it should go into an asset account that's called securities. There is no asset account that's called securities, so it's got to be other assets. So for the balance sheet, the other assets, we originally had just equals F16. We added to this minus the other operating assets, and we're going to tack on to this minus other investing activities. So typically, any other line item, typically in the operating and investing activities, goes into other assets, typically. Unless you can read the line item and do some research and say, well, this should be PP&E, and just by if you don't know if it's clearly other, completely unknown, it should go into other assets. That's the short one. That's the simple way to look at it. Okay, now we're left with treasury stock. Okay, treasury stock was a strange one for Walmart, because usually treasury stock goes into a treasury stock line item. And on the balance sheet, you can see there is no treasury stock line item. But what I did notice that was strange, there should be a line item called treasury stock. It was strange they didn't have that. What I did notice was strange was that the retained earnings jumped from 68 to 82 when our net income was relatively steady. I thought that was weird. I did a word search on retained earnings, and sure enough, there was a retained earnings table that explained that treasury stock was lumped in with retained earnings. I don't see that too often. So I added treasury stock to retained earnings. If you look at, I had to do some research. I went retained earnings, and there was a table that explained it. That's in the book. I don't know how important it is to. I think it's right here. No. Okay, well, it was in the book. They broke it out. And you can even tell, once we link in the retained earnings, it's going to go back to steady levels. So I'm going to add on to this plus the treasury stock, 7 billion. And now we're close to the climb that you expect to see. So that covers purchase of non-controlling interest. Sorry, purchase of common stock.
What do you do?
I added to the retained earnings the treasury stock. Okay. Now the leftover line items will probably go into other comprehensive income. Let's check. We have other financing activities. Usually I put other financing activities into other non-comprehensive income. If it's a financing, it won't go into an asset. It usually is related to foreign currencies or derivative hedges, fees on derivative hedges, fees on debt pay downs, things like that. So that's usually other comprehensive income. So I will link this into other comprehensive income, and also this effective exchange rate on cash, I will link into other comprehensive income. So accumulated other comprehensive income equals the year before plus other cash flow plus exchange rate on cash. We've highlighted everything green, right? We've utilized everything. So for the balance sheet, we should just copy over these totals, the total shareholders' equity. The non-controlling interest should stay flat, and the total liabilities should carry over, and it balances. Yes? Say again? It would change if they had a cash flow line item reflecting the payoff of it, but there was no cash flow line item reflecting non-controlling interest. There is this redeemable non-controlling interest, but the redeemable was a separate line item, redeemable. So I put it in there because that was labeled exactly redeemable. If there was a non-controlling interest line item, then I put it in there. Well, it stays flat. I mean, typically the value should change as the business grows, but there is no indication of that. And so once you have that balancing, I would copy the whole column over. Right? So my recommendation is just to do one column. And when you do the whole column, and that column balances, then copy things to the right. So you can see how this balances, right? So in summary, the way the balance sheet is balancing and the reason why the balance sheet balances is because we have utilized each and every cash flow statement line item in the balance sheet, right? So you can, if you start to think about and understand that concept, and we've been seeing it here from day one when we start drawing out the flows. There are reasons why a balance sheet could be out of balance, and there are 4. And you should start to think about the 4 because, again, when you're faced with a case situation, you should be able to identify it this way instead of going line by line and looking for 100 possible reasons why a balance sheet is in balance. 1, there is a line item in the cash flow statement that's not been linked to the balance sheet. So you can go through this whole process. You can go through all the cash flow statement line items, link the balance sheet lines, and there are still some cash flow statement line items that you did not link into the balance sheet. That would cause an imbalance, right? A balance sheet balances when each and every cash statement line item is linked to the balance sheet once and only one time. 2, there's a line item in the cash flow statement that's been linked in 2 places in the balance sheet. Very common. I see this all the time. So you're going in, and maybe this is where it's important to highlight things as you go along. You see like an other asset, cash flow line item, and you link it into other current assets, right? And then you're going down, and you're not marking it off, and you see other liabilities, and you link that same other asset line into other liabilities. You're linking that into 2 places, 2 other line items, because you're overlooking other. You're double counting. That's a problem. So that's why when you're crossing things off, if you've seen it's already been used, you'll know not to use it twice, right? 3, another common error, there's a line item from the cash flow statement into the balance sheet that's linking into the proper line item, but it's going the wrong way. This is where, in other words, it's increasing your balance when it should be decreasing or vice versa. This is where having a good structure and formula would help avoid one of the major problems. If you have a good structured formula where you know that there's 2 terms, the first term should always be column F, F8. The second term should be from the cash flow statement, column G. You can easily kind of eyeball down and say, all right, well, FG, 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 FG. And if you see something, and it should be, minus, 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 minus for assets, plus, 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 plus for liabilities and shareholders' equity, that would avoid problem 3. I also mentioned in problem 3, it could be linked to the wrong column. Sometimes linking property, we accidentally linking 2012, we should be linking 2013. Again, having a clean structure and formula would avoid that problem. So the first thing I do if you want to be quick is just to kind of look down and say, all right, FG, 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 minus, 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 plus, 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 to avoid a lot of possible error. So those are the 3 major problems. There's a 4th, but my recommendation for trying to solve a balance sheet, but the best recommendation is to print it out, right? Print out the cash flow statement, print out the balance sheet, take a calculator, take a pencil, and just subtract by hand, right? Error proof, and then check off the cash flow statement as you go, right? But on a laptop, my recommendation is forget everything that's beyond the first unbalancing year, right? And first of all, your historicals must be balancing. If your historicals are not balancing, then you've typed in something wrong, right? You've hard-coded improperly. Go to the first year that's not balancing, create a differences column. Differences. And subtract. Subtract 2013 from 2012. I don't care which way you subtract it. Subtract, copy all the way down. These differences from year to year should match cash flows. And I'd recommend to go down line by line, ask the same 2 questions you asked yourself when building the balance sheet in the first place, which is 1, which cash flow statement line item should drive this? And 2, is it going the right way? So in other words, okay, my cash is going up by 2.14 billion. So which line item should drive cash? Cash, right? So what's my cash line? 2.14 billion. That's question 1. It matches. Good. 2, is it going the right way? So you want to just step back and conceptualize it. All right, it's 2.14 billion. Good. That's positive cash. That should be increasing my balance. Is my balance going up? Yes, it's going up. Good. So you're done with that. It works. Cross it off from the cash flow statement. Go to the next line item. Ask yourself the same 2 questions. Go to the next line item. Ask yourself. So when you get to the bottom of the balance sheet, you should have every single cash flow statement checked off, line item checked off once and only one time. That's it. It takes you 25 minutes. There's no other way your balance sheet can be out of balance. And I don't know why you see analysts staying up all night long, because they do this. They go, okay, like they look at this, and they look at this, and then you start getting tired, and then you go like this, and you'll never figure it out. Well, you could figure it out that way. I don't want to say you never, but it takes you a long time. Conceptualize it this way, it shouldn't take you more than 30 minutes, right? So, again, if you've gone down and you realized you did not check off a line, if you've gone through this whole process, you realize there's a line item that you didn't highlight, then that's a problem of type 1. Cash flow statement line item was not linked to the balance sheet. If you've gone down and you realize you checked off the line item twice, that's this, right? That's mistake number 2. If you've gone down, you checked off the line item, right? But you realize that the number doesn't match, right? Then that means it's linking to the wrong column. If you've gone down, the number matches, but it's going the wrong way, then you're missing up your pluses and minuses. There is a way, though, where you could go through the whole process, everything checks off, everything's checked off once, you've used every single line item, everything's going the right way, it still doesn't balance. And if you've done that, that means there's a totaling problem. There's a problem with your total. There's, the mistake that I made. You've got to add up your operating activities. Very common. Your operating activities is not adding in the working capital, or there's a totaling, or another common problem is, for some reason in your balance sheet, your total your total liabilities did not include the current liabilities for whatever reason. There's a totaling problem. If you go through that, your balance sheet must balance. So I'm going to copy this to the right. What I had given you, does everyone have the model? Done? Can I see that? I realized I didn't copy it on mine. This is what I'd given you. So I'd like you to use this method. So David, to answer your question from yesterday more specifically, because you asked me a question about the test, right? Part 1 is going to be Q&A. Part 2 is, are these flows but complete, right? Just like the day 1 test. Part 3 is going to be, I'm going to give you a model. It's not going to be this model. It's going to be a different model. And you have to balance the balance sheet, right? But I don't care. I'm not going to ask for the model. I want you to write down, there's going to be 5 things wrong with there's going to be a lot of things wrong with the balance sheet, but 5 things that actually impact the balance. I want you to write down what the problem was, right? So it's not about, I don't care how you got the model, you could have copied it, whatever. I want to know that you know exactly what the concepts, why it was out of balance. So that's what the test is going to be. Yeah, yeah. So I gave you this. I wanted to do this. I wanted you to do this in class, but it's now 5 minutes away, so I'll have you do it as homework, is to try to fix it. Try to balance it. You probably have enough balancing problems with your real models. But this is a good exercise. Just don't. There's not a test. I'm not going to ask for it. Just give yourself 30 minutes. If you're not doing 30 minutes, we'll do it together tomorrow, and I'll give you more. Maybe I'll give you one over the weekend. But it's important to kind of get this done. So what I recommend is, if you have it, just take a quick look at it. It's 3 statements. 2013 isn't balancing, so we got a couple minutes. I'll get you started, right? The first thing I do is delete 2014 and 2017. Not balancing. Keep 2013, that's the first year that's not balancing. And create a column called differences. Underline. and I'd subtract. I don't care which way you subtract. If you want to be accurate with the subtractions, I'm just going to subtract 13 minus 14, copy all the way down. I don't care about formatting because once I get 2013 right, I'm going to copy it over, and which would fix the formatting. I'm going to copy this all the way down. I don't care about the totals. And I'm going to, okay, nothing here is highlighted, so. The model's a little bit different than the one I just gave you. So I'm going to go line by line. So my cash has gone up by 958.9. So I expect changes in cash and cash equivalents to be plus 958